Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar being brought to us by Stock Traders Daily. Today's topic is on identifying and confirming a Doji pattern. And for today's presentation, we're very pleased to have Thomas Key, President and CEO of Stock Traders Daily, for our presentation. So what I'm going to do right now is pass the controls over to Tom, and if you can share your desktop, we'll get underway. So everyone, please join me in welcoming Thomas Key. Thanks for joining us, Tom.
Thank you very much. I appreciate it, and I appreciate everyone who has joined as well. I always like it when people show up to these things early, in fact, because it seems everyone sort of trickles in at the end. But I know all of our time is valuable, and I'll try to make this as concise as possible. You'll see as we go through the presentation that I like to keep things relatively simple, but I'm sure there are going to be questions, so make sure you ask them along the way. I'm going to start by asking a couple of my own, and this is really designed so that I can get an idea of who I'm talking to. So I'll put a couple of polls out there. The first one is, do you use technical analysis for trading? I'm interested to know this, to see who is experienced really and who's using it, who sometimes uses it, who's never used it. Gives me an idea how to gear my presentation towards the audience. Perfect. As you can see, about 58% use technical analysis exclusively, 33% sometimes, 8% rarely, and looks like none of us never use. None of us are in the never use category. That's great. Next question that I have is, do you know what Dojis look like? Dojis are interesting patterns. They're relatively simple to see once you know what to look for, and we're going to talk about that today. But most of the people, it looks like, in our presentation have some experience with knowing what a doji looks like. Some know, 10% know, and about 18% I think so. This gives me a good starting point. And it allows us to engage this presentation in a way that will benefit most of us, I think. Dojis are very useful to me. We've been using Dojis since we began Stock Traders Daily in January of 2000, and that was the virtual peak of the internet bubble. We sort of fell into the need for proactive trading strategies. That means we needed to learn how to use proactive trading tools, and Dojis were integral to that. So we've been using Doji patterns for a long time. Doji patterns basically identify degrees of confusion in the market, and confusion creates opportunity. Now, opportunity is the identification of turning points. What happens is when a confused market environment exists, the probability of a turn in the market increases. And if we're able to identify those higher degrees of probability, we are therefore quite probably able to take advantage of the turn when it happens. So there's an ultimate objective, of course. And when volatility actually exists, unlike what we saw in 2017, this is 2018, of course, this time frame that I'm showing you here, when volatility exists along with those trading tools being effective, hey, look, we can get a nice little piece of these pies. This is a big move. This is 20% down and 20% up in the NASDAQ 100, and that doesn't even include the last couple of days. I mean, did you get a piece of that move? The objective in doing this is really to allow us to grab a piece of these market moves when they happen. Now, interestingly, if you've been watching the market for years and intensely like I do, you'll notice that there's been virtually no volatility for years up until last year. And that's because stimulus was flooding the economy with fake money. And with that, creating a fake demand or an additional demand that really padded volatility that would normally exist in stock markets. Because that's what stock markets normally are like. Stock markets normally have degrees of volatility. We didn't see that for years leading up to 2018, but now that's changed. And with that, volatility is back, and volatility is a trader's friend. So part of what we're doing here is also embracing opportunity, embracing a changing of the guard again, if you will, back to more normal conditions now that stimulus is over. We're clearly focusing on the stock market. That's my focus, at least, if you know much about Stock Traders Daily. But we also are covering ETFs, and Dojis apply to those. Indexes, absolutely. And of course, individual stocks. So these Doji patterns that we're going to talk about, I'm going to be referencing stock markets. However, these can be applied to all ETFs, indexes, and individual stocks. And when I reference Dojis, you're going to hear some other terms from me. I'm going to talk about big W patterns and Fibonacci calculations, and I'll reference those slightly. Dojis are one of many type of technical tools that we can use to identify turning points. So if you have questions about anything that we talk about, again, just make sure you ask, and we'll address those at the end. So why Doji patterns? Why are those important to us? And it's really about probability, right? The probability of a turn after a confused environment. That's what we're looking for. We're looking for early notifications that tell us what's going to happen in advance. But we really don't care which way the market might turn, right? If the market's moving up and it stalls and it's turning down, fine with us, because we can use our tools to take advantage of that, our trading instruments. In other words, if you're taking advantage of the downside, you can use a double short ETF, for example. An SDS instrument for the S&P 500 would profit from a market decline. That's Sam David Sam. That's the double short ETF on the S&P 500. The opposite would happen if the market's down at a bottom and we see a doji and it reverses higher. Well, then we would want to be exposed to the long side of the market. So we have tools in our ETF spectrum, and there's a lot of different ones out there to choose from. But there's tools that can help us take advantage of this. But the dojis themselves tell us when the probabilities of a reversal in one way or the other exist. And again, when we have renewed degrees of volatility, the opportunity increases as well. The question is, and this I'm sure is what's on everyone's mind, how did a doji help us identify this move? Well, look at up here. Look at this upper left-hand box, this circle, and take a closer look at it. And look at the inner circle that existed in October of 2018. For those that look for dojis, that's a doji pattern right there. This is what dojis look like. They're like a big cross. And there's different variations to them, of course. There's candle legs and there's candle bodies, but ultimately the dojis tell us that the market started and stopped in the exact same place after experiencing an aggressive move. Again, this could be market, it could be ETF, it could be individual stock. We're talking markets here. So in this example, in this first left-hand doji, the market moved up to this level, down to that level, and then ended flat. It could have also declined to this first, increased to that second, and ended flat. Either way, it ended at almost the exact same level as which it started after experiencing degrees of volatility. The same here, the same here, the same in all doji patterns. It starts and it ends at the same place after experiencing degrees of volatility either up or down or both. Now with that, for those that weren't able to see or know what dojis looked like before, does this pattern now look familiar to what we just saw in that doji diagram? This is what existed in October. So let's look at dojis a little closer. Okay, we're going to look at more than just one market. That was the NASDAQ 100. We're going to look at more than one market. I use the Dow, the NDX, NASDAQ 100, the S&P 500, and the Russell 2000 for my reviews. And I write charts for 5 days, I write 20 days, and I write 6 months. And for this particular observation, we're going to use daily candles in our chart observations, and we're going to take a look at what dojis look like in some of the other markets too. Again, we talked about this first doji in October, and a 20% decline followed. And the same type of thing happened in the S&P 500. But the S&P 500 in October experienced consecutive dojis, back-to-back-to-back doji patterns that still identified the beginning of a decline. So the markets were corroborating themselves, in other words. But in the S&P 500, during that decline that started last October, there was another short side doji signal on October 17th. That was the second one. There was a third one on November 8th, all followed by aggressive market declines. And there was even a buy side signal from the dojis on November 23rd. So we had 3 short side dojis, and the first buy side doji pattern showed up on November 23rd. That was followed by a 5th doji, which also was an engulfing, followed by an engulfing red candle. Now, this engulfing red candle is important. That pattern developed on December 3rd, and the engulfing red candle that followed created an almost perfect doji pattern. This is good because this is real life. You guys probably remember this. And this pattern identified the risk of a material decline perfectly as it was happening. This is a perfectly shaped doji with an engulfing red candle that gives downside confirmation to the market. Look at this a little closer. We have a confused environment here. The market starts around here and then breaks down to a lower low and confirms that confused market and a reversal. That confirmation doji in this particular case was a downside confirmation doji. Of course, you can get upside confirmations once too. Just flip the chart around and you can understand what that looks like. So in all, there were 5 dojis in December's decline, and that decline was aggressive. And that decline was profitable for people that were looking at those trading opportunities as well. But let's look at more recent trends too, because it's important to identify consistency. In this shorter term observation, I'm going to use 60-minute candles. So it's a little bit different than what we were using before. I'm going to use the NDX again. And looking at this from a rally that started at the early part of March, the market increased, the NASDAQ 100 did, and established a top on the 21st. That top was associated with consecutive dojis again. The doji patterns that existed on March 21st were followed by a 3.3% decline in the market. This is something that traders want to identify because they can take advantage of that. Looking back at that double short ETF reference, well, if you use a double short ETF and you capture a 2% decline in the market, you really made 4% because it's twice the market. So there's opportunities here to make good money trading using these doji patterns, but you can't get greedy here. These are trading tools, and the doji is a trading tool, and it should be treated like that. Take your money, pocket it, and play again the next time. That doji pattern as well identified the beginning of a big W pattern. And these type of patterns are something that traders and technicians love to identify. It was the beginning of this big W pattern that was the doji. So dojis are leading indicators. They're leading indicators to the development of trading patterns like this big W pattern, of these major turning points in the market, as they identify the increased probability that the market itself will make a turn, or that the ETF we're talking about or the stock that we're talking about will make a turn from either higher to lower or vice versa. And that's because they identified confused conditions, and in confused conditions, those shifts are more likely to happen. You could say that sentiment is vulnerable in those types of conditions. And recently, shifts in market direction have followed. So The dojis have been working. They can also work for near-term purposes, what's happening on a daily basis, or they can be stretched out to weeks or months. Rarely do you want to go much further than that. But the dojis can work in near-term and longer-term type of trading environments. Of course, other technical tools can support that as well. Fibonacci helps too. You'll see a reference to that in a minute. But these dojis being leading indicators to probable turns are very, very valuable. The recent tendencies, though, have been that the doji patterns have been working best on the short side. Think about the 5 dojis that happened in December's decline. 4 of those were short side dojis. 1 was a long side doji. Recently, the market has moved straight up. In fact, since that December 26th ultimate low that we've seen recently, that recent ultimate low, the market's moved basically straight up. The interesting part about what I'm seeing is that doji patterns are being less effective when the markets are moving up than they are when the market is experiencing a drawdown or a pause. And that's largely to do with volatility. The market recently, as it's moved up, has moved up with largely no volatility. And in order for us to make money as traders, we like to see a degree of volatility. Now, the good news for us is that although these last couple of months look like there's no volatility and it's reminiscent of 2017 all over again, we know that stimulus indeed is over. And so that catalyst that really padded the market from volatility throughout 2017 and the years before, that's no longer there. And so if no more stimulus is there, that means that the market is going to trade normally again at some point. That's going to happen. And if that happens, we're going to see more volatility and we're going to get more opportunity, and trading tools like doji patterns are going to be effective again. That's important because they haven't been effective until recently. During stimulus, it was very hard to trade the market because the trading channels were tight, the direction was straight up, and there was virtually no volatility. But those days have changed. And with that comes our opportunity to trade. It also requires us, however, to be objective. We can't be a bull in headlights. Look, this isn't 2017 all over again, right? It's not. We have to be objective. We have to be reasonable. And I like being rules-based, but I am not a bull in headlights. Part of that has to do with when we were established in the peak of the internet bubble. We have built-in proactive built into us, if you will, and that's great. But when you look at these technical tools, make sure that you do it with an objective mindset. You can't go into it with expectations of where things are going to go. That prevents you from listening to what it tells you about future market direction. So make sure that you are objective. And if you are, those trading opportunities that seem to be non-existent for years can come right back to you. I had this smiley face. Instead, I had a picture of Trading Places here, and I used a "we're back" Randolph analogy, but I think there was a copyright issue to that one. But imagine Dan Aykroyd and Eddie Murphy sitting there. One of my favorite movies. But trading strategies are back, Randolph. They are back in vogue, and we are able to make money again trading where we weren't able to before. But it's up to us to use it, right? And so how do we use it? The way we do it is we keep our eyes open. That's what we have to do. And we have to review the charts. That's what we have to do. And we have to do it consistently. And if we do that, we're going to see them because they've been appearing regularly. Look at 60-minute charts. Look at daily charts. And look at candlestick patterns for sure. I should have said that from the beginning. Candlestick patterns are all I use in chart formations and identifying dojis. Look for the dojis. And then look for a confirmation candle too. An engulfing confirmation candle confirms the warning that the doji is offering. And that combination is a leading indicator. And it identifies the increased probability of a continued move in that direction in advance. So in order to use them, we have to identify them. And in order to identify them, we have to just open our charts and watch. And I suggest doing it on a daily, using daily candles and using 60-minute candles. Those are what I referenced in this presentation so far, using the longer term and the shorter term, respectively. And that doji pattern helped us identify the beginning of this down move, and that was fantastic. But since everyone has a buy-side mindset recently, especially now with the market breaking out into all-time highs, what identified this bottom? The answer to that is Fibonacci. For that, please send me an email if you're interested in receiving a Fibonacci report, because we're not talking about Fibonacci in this presentation, but the Fibonacci calculations identify that December 26 bottom almost perfectly, and the market increased by 1,000 points afterwards. So it's, I think, quite valuable to understand what Fibonacci is also saying, because Fibonacci is also supporting the findings from the doji patterns. So in conclusion, the doji patterns that we are identifying and that we're watching on a regular basis are helping us identify turning points in the market before they happen. And I think that can also be true for you. So with that, if you have questions for me, please ask those questions in your questions section, and I'll begin to answer them.
And at this point, what I would like to do is remind everyone there's a questions panel that's included on the right-hand side of your screen in that control panel. Simply double-click that questions title bar, and you can add any of the questions that you might have at this point. So back to you, Tom. I see a few questions are coming in.
Sure. I have a question of when is it a bullish doji and when it is a bearish doji. I'm going to close out my full screen mode here and open up a chart pattern for you. Hopefully I can minimize some things and show you something. Okay, so there's a doji right here, right now. Okay, this was last week's doji pattern in the S&P 500. And this pattern is happening at a relative high. So typically a doji pattern that would be a bearish doji pattern would happen at a relative high and then be confirmed to the downside. Or it would have a back-to-back doji and maybe 2 consecutive dojis in a row, that kind of an environment, that could create a bearish doji pattern, but only if you have a negative candle right here. So you'd want a break or a red candle and a breakdown below this relative low or the down leg of last week's candle. And if you get that, then you'll have a bearish confirmation as well. So with that, I could put a question out there, but I'm going to ask the question and then I'm going to answer my own question because I'm not in an open class environment. But with this, what would it take for there to be a back-to-back doji this week after last week's doji appeared? And the answer is the S&P 500 would need to decline to about 2,900 from where it is now in order for there to be a back-to-back doji. So where's your warning come from? Your warning comes from, if that happens, position yourself for a decline. That's the warning that would tell you if that happened. So that hasn't happened yet. We don't know if it's going to happen, but you can imagine that if that happens and then there's a break below last week's lower leg of the candle, that you're going to have a downside confirmation that can tell you to expect declines. Now with that, there's a lot of room for the market to decline. So if there is a consecutive doji here and we do have a bearish confirmation, it could be very opportunistic as well. I hope that explained what a bearish doji would look like. A bullish doji would be a similar pattern at a relative low. So a similar doji pattern looking for a bullish candle that breaks the upward leg. This is not a doji, of course, but if it was, it would have similar characteristics just on the opposite side of what I just described to you. Harry asks, so it works during a day trade with 60-minute candles. Yeah, Harry, that's what I found. These 60-minute candles, looking at what's going to happen over, say, the next couple of days, absolutely the doji patterns seem to work for day trading purposes. But You know, I think I'd extend that out to swing trading more than day trading, because day trading sometimes could be, let's just say, sporadic for one reason or the other, where the doji may be better representative of what might be happening in the next couple of days on a 60-minute time frame. So I would look at a couple of days or swing trades rather than day trades for those 60 minutes. Can you show the engulfing candle confirmations again? I wasn't completely clear, David says. Let me see, David, if I can just pull this up. Are we? Bear with me. I'm gonna have to go back to the slide presentations. Bear with me for a second. I'm looking for the red engulfing candle that you asked for. And that's it. So you have your doji, and then you have an engulfing, red engulfing candle there. And then you have another one as well here. And I think this is probably the one that you were asking about specifically, because this is the perfect looking doji pattern. And the reason that it's a perfect looking doji pattern is because the market was confused the week prior. Then it started the week kind of, let's just say, within the boundaries of this candle leg. And so it was in the boundaries of this candle from the week before, and then it broke down below the lower leg. And when that breakdown below the lower leg came, that was the red flag. That was the indicator that the additional downside is coming and we should be positioned for it, right? So the confused nature the week before, the participation still within the candle the next week, and then a breakdown below the lower leg was that confirmation. Hopefully that answered your question there, David. How do you get out of the doji trade? That's a good question, Vikas, because it's subjective, right? And that's the truth. That's the nature of trading these things. We want to get positioned at the right time, and the dojis help us to do that. But when do we get out? My suggestion at the beginning, or in the early part of the presentation at least, was that we not be greedy, right? And that's the best thing I think that I could advise anyone that's engaged in trading practices. Just don't be greedy. Take the money and run. In the December decline, there were 5 dojis. So if you took money early one time, you could have gotten back in and gotten back in again and again and again, right? So this is a trading tool. This is not a buy and hold instrument, and you need to be willing to take profits. Nick, yes. Okay, so 8 candles ago, you had a red engulfing doji after a doji, but the market went up. I'm not sure exactly where you were looking at this one, but it happens sometimes, right? This is not absolute. Dojis are not absolute. They are designed to identify increased probabilities, right? And the increased probabilities are what they do, all they do. Okay, we're not going to say that they always are followed by a turn, because they're not. But the probabilities of being successful or identifying a turn are increased dramatically when we identify these dojis. And our job as a trader is to increase our probabilities as much as possible, right? So a doji isn't an absolute. It's not always going to be perfectly identifying a turn. There might be one doji in a perfect turn, but maybe there's 5 dojis in a row before a turn happens. Or maybe a turn doesn't happen at all because there's not a confirmation or something like that. These are all realities, because that's the nature of the market, right? The nature of the market, it'll always at some point do something that is relatively unexpected or out of the ordinary. That's just the nature of it. But probabilities increase when we use these, and that's the goal of the doji pattern. Thanks, Nick. Yeah, you're probably right. Nick is repeating that there was a doji that looked like it was a reversal doji that ended up being followed by a market increase, and that's exactly right. That might also be a good way of, and I didn't intend to talk about stop losses, but heck, if you're identifying a probability and you're entering a trade, well, all trades should be rule-based, right? They all should be. So if you're entering a trade near a relative resistance level, which is essentially what a doji is identifying, and that level starts to break higher instead of lower, as seemed to be the case or seemed to be the opportunity, then you need to stop out of your position, right? Because that's a rule. If the trade goes against you and that resistance level starts to break, using the example of a resistance-based doji, then you need to get out of it. So trading strategies also need to be associated with rules, right? They're not absolute. And if the doji doesn't work, you don't sit there and plug your nose and hope for the best, right? If the doji doesn't work, we need to take action to protect our position, and that way we'll trade again another day. Greg asked a question. Have you done a study and got a number which describes this probability of the doji as a turnover candle? No, I have not. I don't have any firm numbers on this, but I will tell you this, in that 2017, it never worked. 2016, hardly ever at the beginning of the year. 2015 worked like clockwork. 14, 13 didn't work at all. There's a reason for all of this, right? And that is that there was so much stimulus coming in during the years. 2015 was different, but 2014, 2013, 2016, 2017, there were on average $70 billion a month being poured into the global financial system. There was no volatility. These trading tools didn't work at all. 2015 they did, because you had a nice degree of volatility in 2015. That was great. And in 2018, they've started to work again as well. What happened in 2015 that made them work? Well, in 2015, the Federal Reserve stopped its stimulus program. So the FOMC stopped their stimulus program. And although the ECB announced that they would start a stimulus program, there were months without any stimulus in 2015. With that came normal degrees of volatility again. Well, that's what we're seeing now. So we're seeing normal degrees of volatility. I expect Doji patterns and Fibonacci calculations and big W patterns all to be working much better than they have in years because of a more normal market environment. Mike asked a question. Are there volume signals higher, lower than average, which will help you confirm the patterns? There's not. I'm sure that volume technicians are going to suggest that there are somehow higher confirmation readings from some than from others, based on higher or lower degrees of volume respectively. I will address volume in this way. Aside from yesterday was a very broad-based rally, right? So I'm talking more specific to current market environments. This market is had a broad-based rally yesterday, but before that, the indicators to me was that the market really didn't have much ability to push itself higher because volume levels were low, right? There was just a lack of sellers. And in fact, that seems to be exactly what happened yesterday. There is a lack of selling interest, not a higher degree of buying interest. And prior to yesterday, what we were seeing was basically a buyer's rotation, where we rotate from the Dow to the NASDAQ 100, back to the Dow, back to the NASDAQ 100, and one would increase at the expense of the other. Now, the other wouldn't decline necessarily, but it wouldn't increase when the other was increasing. This was something that was tangible to me. So I'm talking about volume levels here on a market-wide basis, not so much about volume levels around specific dojis, of course, but volume is important. And I'd add that a degree of risk, in my opinion, exists around this all-time high because of what I saw volume-wise in the days prior and the weeks prior. And this rotation, I called it a buyer's rotation that took place. I'd add that. So when I gave this observation about last week's doji and what would it take for a consecutive doji to appear this week, keep your eyes open for that, because that coupled with this buyer's rotation phenomena that I'd identified could be, some bigger red flags than normal. So I'm not sure that even came close to answering your question, Mike, but it's volume related nonetheless. All right, I don't see any other questions here. Please ask them if you have them. I'll conclude with something that I think is important. If any other last minute questions are there, they make sure to get asked. there's a natural, let's see, how do I say this? There's a natural way the market usually moves, right? The market has natural levels at which it stalls at, natural levels of which, it's just gone down too much and it's going to turn higher from. And if we let, and I say we as an economic community, if we let markets move naturally, we can use these tools to take advantage of them. But during the stimulus phase, we have not seen a natural market. I am so thankful that stimulus is over. Everyone else might be wondering what's going to happen now that we don't have all these billions of dollars flooding the economy. They may be more concerned. Personally, I think it's great, and I'm glad that that stimulus is over and the markets are moving more naturally, because these Doji patterns are working, the Fibonacci calculations are working, and trading tools in general are working again. Nick asked me, is this valid on a 5-minute or a 15-minute chart? You can, if you want to get specific, but or get even more narrowed down into day trading practices. But if you're getting that far, that tight, I would much rather use straight line technical analysis than I would Doji patterns on a 5-minute chart, for example. Right? I would rather use the straight line text than I would ever use a Doji pattern that finite, because the move that follows could, depending on what the market's doing that day, be a 3-point move in the S&P 500, right? It just could be fruitless. So we don't want to, we want to make sure that we try to use these in a capacity where we're able to benefit from them, and that's relative to what the market, the probable market move might be. But if you're using a 5-minute candle, you're looking for a day trading quick move. Is it possible? Yeah, sure, absolutely, it can be. But I like straight line text over Dojis when I get into that kind of day trading spectrum, for sure. I also saw daily and weekly candles. Which scenarios for this for stock options trading? So my opinion about stock options, let's talk about market futures, right? I personally don't like trading stocks because stocks have so many moving parts that they're very hard to deal with. We never know who's going to be selling for what reason. Is a stock going up after an earnings beat, or is it going down after an earnings beat? It's hard to tell what's going to happen in an individual stock because there's so many moving parts. The markets themselves are much easier to navigate, and that's why I focus on the markets. I also have instruments. We have instruments to trade the markets much more efficiently, which much greater liquidity. So I had a question from Harry about stock options and trading, Dojis with daily and weekly candles in relation to stock options. In my opinion, I would scrap the idea of stock options altogether, and I would look at much more liquid vehicles with much less of a disparity between the bid and the ask, much lower spread, right? And those are the market-based ETFs. So we're talking S&P 500, we have been, and NASDAQ 100. I'll give you what I use for both of these. They are already leveraged, and if you're using options, obviously you're looking for leverage, but these are already leveraged ETFs, and you don't have to short anything. You just buy them. They're very easy to use in IRAs as a result as well. But for the S&P 500, it is SDS, Sam David Sam, which is the double short S&P 500 ETF, and SSO, that's Sam Oscar, that's the double long S&P 500 ETF. Those are very easy to trade. They have exceptional degrees of liquidity. You don't have any problem and getting in or out of them, and the spread is tight. When I say any problem, I should say that's relative based on where you want to get in or out of them. But there's plenty of ample liquidity in those ETFs. The same exists for what we use in the NASDAQ 100. So the NASDAQ 100 has the double short ETF is QID, that's Qualcomm Ida David, and the double long is QLD, or Qualcomm Larry David. These ETF combinations, coupled with just the market analysis, the tech analysis on the market, are really all you need, in my opinion, to make money from the market. You don't even need to listen to news, because you know what? All of these chart patterns that you read, they are already reflective of what the smartest guys in the room interpret whatever news happens to be on the headlines today as being. They're speaking with their pocketbooks. They're typically smarter than you and I. And even if they're not, we make money by trading the market. And so we need to listen to the market, not the headlines. So when we use technicals and these trading tools and we couple them with just the market itself and market-based ETFs, we distill a ton of the noise that distracts people from a day-to-day operation that would probably make them much more efficient at everything they do in life. So my mother-in-law watches CNN nonstop and I can't stand it, but those type of things can be distracting, right? When we look at just charts, markets, and market-based ETFs, and we don't have any of the company noise either to deal with, things get much easier in my opinion. And that's ultimately the goal. Make things efficient, easy, rules-based, and if we can do that, maybe we can get a little peace when the market moves by 40% at any given time. So thank you very much, Vikas. That's the conclusion of the presentation. If there are any other questions, I'm sure that we can get those answered for you if you mail Cynthia, and I'm sure she can get a question to me and I can get the answer to you. I appreciate everyone's time today. I hope this was valuable to you. And Doji's have been working, so keep your eyes out for them and use them to your advantage if you're able. Thank you very much, and hope to see you again.
Well, Tom, if you could stick around for just another moment, I'm going to take the controls back because I do want to show everyone that access to Stock Traders Daily is available through your Interactive Brokers account. Now notice there's actually several different places on our website and through our trading platform where you can access the information that Tom provides on a very frequent basis. Now notice I've got our website has opened up here, and I first want to point out that underneath the education menu, you'll find that Tom is a frequent contributor to our Traders Insight platform. Going into this platform here, you can access from the education menu. And what I'm going to do is I'm just going to bring this over because what I have done is already filtered by provider here. So notice that you can simply choose to identify Stock Traders Daily, and you'll be able to locate any of his previous entries here. So do want to show you that there's a lot available by simply coming to the website. Now, in addition to the Traders Insight, I also do want to point out that Stock Traders Daily is available as a research platform within your Trader Workstation. Now, notice here I'm going to go to Research News, and where you can find information about all of the different research products that we do have available. Now notice that on this page here, you can scroll down, and once again, I've brought this, and notice I'm bringing it to that page, and simply scrolling down, you'll find Stock Traders Daily. Now notice here that there's some additional information. We do provide a free 30-day trial period if you'd like to give it a try. Also notice that at the bottom here, this will take you to an additional page where you can learn more about what's available when you do subscribe to Stock Traders Daily at Interactive Brokers. Notice here there's different trading reports that are available and even direct access to the Stock Trader Daily website. Now, in addition to that, I'm simply going to minimize these windows here, and let's get into the Trader Workstation. Within TWS, you can access Stock Trader Daily reports. Notice here, underneath the New Window button, there's Analyst Research that's available. Now, when you do subscribe, you'll see, well, first of all, there is a free daily report that's available in TWS, and then there's also trading reports that are available by subscription. If you've not yet subscribed, notice here that Stock Trader Daily trading reports will appear down below. From this window, you will need to subscribe either to that free daily trial or simply subscribe through account management. Now, in account management, when you go in, you'll actually find it's listed underneath the settings menu, and there's user settings where you can make that subscription. Now, once you do subscribe, notice that those reports will be available underneath the new window button going into Analyst Research, and here you can find those daily reports. Notice here how it does open up in a separate window within your trader workstation. Now I'm going to close this window out because I've also found that if you do want to take a look at those daily reports, you can actually create a separate tab within your news window. Notice here I've got it labeled TDRS, but what I do want to show you is how you can create that. You'll see that here are all of those different reports that are available, and notice here the time that they were listed. Now, going into this window, by the way, you can always create a new window by simply clicking that plus icon or plus tab here. Once you've created that window, I'm going to go into global configuration settings and show you that underneath the Newswire service, general news, you can filter by Stock Trader Daily. Now, if you do have access, you'll find that many of these are checked off that are available at no additional charge. So simply do deselect any of those. And as you scroll down here, you'll see alphabetically listed will be the Stock Trader Daily, the daily trading reports, and then also those free reports as well. So once you've activated this, click Apply and OK, you'll be able to see all of those Stock Trader Daily reports included on this window. By the way, if you're looking for something recent, notice that you can go into that search field and type a ticker symbol. So I'm just going to pick up a ticker symbol, go ahead and click Enter here, and you'll see that this will now filter for any of the recent reports for the ticker symbol that you're looking for. So I did want to show you that this information is available as well. By the way, once you double click, I'm just going to open up a screen and you'll see that for that underlying ticker that I pulled up, here are the recent reports that Stock Traders Daily has put out. So with that, looks like we are going to conclude today's session. I'm not seeing any additional questions come in. And once again, I want to thank Thomas Key for today's presentation. By the way, I want to let you know that we have been recording today's event, and each of you will get a direct link to today's recorded playback soon after the session ends. I'll also be including those same slides that we've used during today's presentation. Now, you can access Tom's information underneath the Education menu. Notice there's a Webinars link, and here is where today's session, underneath the recorded webinars, will be posted later on today. But by registering, each of you will get a direct link to today's recorded playback later on this afternoon. So watch your inbox. So with that, we are going to conclude our session today. Once again, thanks to Thomas Key and Stock Traders Daily for a very interesting and informative session. Also, do want to let you know that you can or want to thank all of you for your participation here with us today. So with that, you can exit today's event using the X in the upper right-hand corner of the screen. Thank you very much for your participation today, and have a great rest of your day, all.